Hi, good evening to everyone. I hope you had a great festival season. As usual, we're happy to take you through our monthly market outlook. If you look at US economy over there till yesterday night, inflation was running ahead of Fed's comfort zone as well as earnings as well as wages growth. But yesterday, for the first time, inflation came below market expectation. Let's hope that this red line of US CPI falls faster and merges with hourly earnings growth. The Fed not only is raising interest rates, but it is also taking out liquidity at a much faster pace. Earlier, they were supposed to do between $60 to $90 billion a month, but finally, they have started taking out that kind of liquidity on a monthly basis. The total liquidity is down about 242 billion from April till December. This is one rare year in US history where both bond and stocks have given negative return. This has happened only thrice in the past. The loss in the debt market as well as equity market this time at about $92 trillion is more than what we had seen in subprime crisis of 2008. The mortgage rates of US are now in high single digit. The gap between Indian and US mortgage rate has come down dramatically over the years. As housing interest rates have gone up, housing applications has fallen through the cliff. This has resulted into many banks looking to lay off mortgage staff. As interest rate goes up in US, their budget comes under pressure. As of today, US interest rate at $716 billion is one of the highest in their budgeted history. As budget is witnessing higher interest outflow, the deficit, which had started correcting from COVID period of $4 trillion to under $1 trillion, is now back to about $1.3 trillion. US deficit is more than GDP of most countries, bearing countries like Japan, Germany, and India. More importantly, Fed, when they issued press release after their last FOMC meet in November, it was very dovish in talking. But when Jeremy Powell, Fed chairman, came to press conference, he unequivocally mentioned that rates will have to go higher and stay higher for longer. He also mentioned that terminal Fed rate is likely to be above 5 rather than 4.63 as expected by the market. More importantly, if you remember, हमने एक slide present की थी, Fed's dilemma, आगे कुआ पीछे खाई, between devil and deep sea. Next slide, please, Avinash. Between devil and deep sea. Now, Fed has said that if we have to choose between devil and deep sea, we will choose devil. They have choice of either raising interest rates higher than necessary and causing recession, or they will not raise enough interest rates and push up inflation. Fed says we will not take risk on inflation. We will take risk on recession, as we can cut interest rates quickly if we are on wrong direction. Clearly, Fed is likely to commit type 1 error of raising interest rates more than necessary in order to control inflation. Can inflation fall like money as money supply growth has started tapering off? This was the chart we had put up well before yesterday's data was announced. And clearly, one can see a reasonable amount of correlation between money supply growth and inflation with a lag. Now, money supply growth has come down to mid single digit or low single digit. Can inflation also fall thereafter? That's the $1,000,000 question. The other thing which US will have to grapple with, their deficit is high. They'll have to issue lots of US Treasury. Unfortunately, appetite for buying US Treasury has started coming down. The foreign holding of US Treasury has come down from high of 34% to about 24%. Partly this is because US Fed has been the buyer of the last resort, but partly it is also because countries are selling US Treasury to fund their FX outflow. Will US keep interest rates higher in order to attract foreign capital? That's again one factor which we will have to watch out for. Next slide, please. The other interesting thing from the equity market point of view, whenever Fed makes a pivot, that means from raising interest rates, whenever they come down to cutting interest rates, invariably there is a correction in the market also. There is a reasonable amount of correlation between Fed pivot and market correction. Will this time be different? Today, equity markets all over the world have run up based on yesterday's rally in Dow Jones and S&P 500. But if history is a guide, whenever Fed has started cutting interest rates, invariably equity markets have actually come down. Coming from the dilemma of US economy, global economy is no different. Their yields have gone up and manufacturing PMI continues to drop. The headline are scarier. In UK, millions of people are forced to skip meals. Half of UK families are left with less than £3 of savings a week. In France, police are checking up fuel tanks before allowing people to fill up as there is shortage of fuel. Clearly, Western world is passing through a tough time. Companies which survived World War I and World War II are now getting insolvent in a short period of time. The hit of energy prices, thanks to Russia's sanction, is putting European companies in a doldrum. Swiss National Bank, which owned shares of Apple Inc. also, has booked a loss of 143 billion in first 9 months. This is unprecedented loss in the central bank's history. If we look at the antidepressant users per 1,000 people, countries like US, Iceland, Australia, Canada, Sweden, Denmark, UK, Portugal are all in the higher levels. Between 7 to 10% of their population is using antidepressant to come out of depression. Clearly, Western world is in serious trouble. The answer to that lies in what Bank of Japan has done. They have been buying Japanese government bonds left, right, and center. Today, more than 70% of benchmark JGBs of 10-year maturity are with central bank. There are days when there is no trade in benchmark JGB because majority of bonds are with Japanese central bank. The way Bank of Japan has maintained lower interest rates, higher liquidity, and absorbed government bond supply, ECB, US Fed, and Bank of England one day will follow in their footsteps. For European institution, the specter of Lehman kind of crisis continues to hang on their head like Damocles' sword. Both Deutsche Bank and CSFB continues to remain under pressure, albeit they are taking corrective steps to come out of trouble. If we look at Chinese economy, it's becoming less and less transparent. They have curtailed disclosure of information through their Bureau of Statistics by a significant margin in last couple of years. More importantly, investors have lost confidence on China. Tiger Global, one of the known hedge funds, paused investments in Chinese equity. There are companies like Matthews who have launched MSCI emerging market, excluding China kind of funds. If we look at MSCI China index, for 30 years, it has not delivered any return to investors in US dollar terms. In that, we have been repeating time and again, Indian economy is like oasis in the global desert, but there is a massive sandstorm blowing globally. The headline numbers by and large have been positive for India, except that retail inflation jumped back to 7.41 in September. The e-way bill declined from peak in September, and currency continued to rise with public. Bearing some of this kind of uncertainty, rest of the headlines have been positive for Indian economy. If we look at high frequency indicators of PMI or e-way bill or industrial activity or automobile sales or financial services, by and large numbers are moving into green trajectory, expansionary trajectory. The capacity utilization now is at 17-quarter high. It is well above pre-COVID level. Economic activities are 25% higher than pre-COVID level. Credit growth is reviving and touching into double digits, not only for non-food credit at about 17%, but also for retail loans and personal loans at about 19%. No wonder India has become the fastest growing major economy in the world for last year as well as current year, and is likely to continue in the next year. This will be the first 3 years where India will be the fastest growing major economy in the world. GST collections are consistently remaining above 1,40,000 crore. That resulted into tax collection exceeding budgeted estimate by about 3 lakh crore for FY23. The e-way bill generation, which was steadily going up since 2021, has witnessed a bump in October 22, and this is a cause of concern. While GST collection have by and large remained good, the drop in e-way bill generation is something which we need to worry about. As you are aware, we have maintained for some time that consumption at the bottom end of pyramid is not up to mark. In this festival season, there was hope that consumption will take off. The numbers have not yet arrived in totality, but at least the survey did suggest that 36% people were looking to spend more money than last year, and about 21 odd people were going to spend less than last year, and 30% odd people would have spent equal to last year. There is also increased level of borrowing to spend money. Now, are people borrowing because they are desperate, or are people borrowing because they are confident about the future? We'll have to wait to see the data to check the hypothesis. The good news about India is correction in oil prices. They are down about 26% since March 22 high to double digits, but it is still in the 90 handle rather than 70 handle where we will be comfortable. Clearly, oil prices are driven more by what happens through OPEC cartelization. There are expectations that US and Europe will go into recession. In the past, whenever US has gone into recession, it hasn't impacted India materially, except maybe 2020, where the drop in Indian GDP was more driven by COVID than by US recession. India continues to run a very large trade deficit. We are importing more than what we are exporting. The run rate has moved from about $30 billion a month to $25 billion a month. But overall, our trade deficit is likely to result into BOP deficit of about $50 to $60 billion. This much money we have to fund by selling our reserves. In the trade deficit, the biggest contributor is our trade deficit with China. This year, our imports are likely to touch about $100 billion. Exports might be about $13 billion and will have an annualized run rate of about $87 billion with China in terms of deficit. This clearly is unsustainable at this level. One thing for India will be, how do we increase our exports market share? Today, in the merchandise trade, we have about 1.7, 1.8% market share. In services, we are at about 4% market share. We are hoping that by 2030, we'll be able to increase our services market share to 6.4%, merchandise export market share to 3.5%, and combined market share to about 4.5%. Clearly, exports will be the biggest driver for growth in Indian context, and achieving this number, becoming not only back office to the world, but also factory to the world, is critical. Next slide, please. If we come to the market side, before yesterday, there was significant correction in US tech giants. The top 7 US tech giants have crashed more than the market cap of India. The largest losses have been absorbed by companies like Microsoft, Alphabet, Facebook, Amazon, and so on and so forth. The foreign portfolio investors in India have generated a reasonably good rate of return in India since 2005. Their IRR is around 8% in US dollar terms. This was one WhatsApp forward which said that whenever Fed is hiking interest rates, Nifty continues to climb the wall of worry. Between Fed's interest rate hike by 75 basis point in June 22 all the way up to November 22, Nifty has moved from 15,700 to about 18,000. If we look at Indian markets performance vis-a-vis US, it is invariably linked to earnings growth. In 2000 to 2010, Indian companies' earnings growth was about 14 odd percent, and MSCI India return was about 12%. In the same time frame, US companies' earnings growth was 2%, and equity market delivered minus 1% return. In 2010 to 2020, US companies grew earnings by 8%, and S&P 500 delivered 11% return. Indian companies failed to register profit growth, and for almost 10 years in US dollar terms, MSCI India did not deliver any return. If we combine both 2000 and 2020, then you can clearly see that earnings growth and stock market returns over 20-year period kind of diverge, kind of converge. MSCI India has massively outperformed MSCI emerging market. MSCI emerging market 10-year CAGR is negative. 5-year CAGR is also negative. In the same period, India has delivered mid-single digit return. Our weightage in MSCI emerging market index is on the rise. From about 8% in March 20, we are now double at 16%. Our weights have gone up as our markets have delivered positive return. Rest of the world's weight has come down as their markets have delivered negative return. India continues to deliver better return than its peer. In last 8 years, we have delivered about 9 times more return than emerging market. In last 12 years, we have delivered about 3 times more return. And over 20 odd years, we have delivered 1.5 times more return. Our valuation premium continues to remain at a higher level to emerging markets. Historically, we trade at about 40% premium to emerging market. Today, we are at 86% premium. Compared to emerging market P ratio, we are at about 149% premium. Undoubtedly, Indian markets look expensive on a one-year basis vis-a-vis rest of the emerging markets. The driver for Indian equity market is domestic investors. In the past, when FIIs used to sell, our markets used to correct big time, like it happened in 2008 subprime crisis, like it happened during taper tantrum. But this time, despite selling of almost 2 lakh crore plus between last 12 months, markets have actually gone up as domestic investors cleaned out FPI selling. FPIs have turned marginal buyers from the month of July. It looks like that they'll continue to be buying India as they have realized this is one market where they have booked their profits and they have invested in markets which are giving them losses. As it downs to FPIs, that India provides better earnings growth opportunity over a longer term, better governance standards, and also green return with conscious for environmental, maybe they will make a U-turn and start investing in India. Do remember that markets are very, very difficult to predict. This is one WhatsApp getting circulated about a stock called Carvana from $420 price target by Morgan Stanley. The stock is currently trading at about $7. There is more than 90% drop in these prices. Clearly, it's very, very difficult to predict market and future. Valuation wise, Indian markets are at marginal premium to its fair value. Historical PE is 18.5. We are at 19.6. Historical PE is 2.7. Historical PB is 2.7. We are at 3.1. We are trading at a marginal premium to our own historical averages. From a market cap to GDP ratio, there was a time when global market cap to GDP ratio was higher than India. Now it has reversed. Global market cap to GDP ratio is 98%, and India's market cap to GDP ratio is at 107%. It's almost 10% premium over global market cap. Our own market cap to GDP ratio at 107% is higher than historical average of 79%. Undoubtedly, Indian market on a one-year basis looks expensive vis-a-vis peers and looks marginally at a premium to historical averages. The result season for large companies, by and large, is as per expectations. 26 companies delivered better than expected performance in terms of sales, but only 7 companies delivered better profit than expected. The earnings downgrade upgrade ratio is more than 1 at 14 to 24, which shows that results are by and large in line with expectations. India's outperformance in recent months is driven by banks. As banks bounced back, it has pulled India's performance. What will FPI do going forward? Many FPI have said that they would like to be underweight India as it is trading at premium valuation to global peers. I think it will be fair to say, be ready for volatility. Yesterday's US inflation data undoubtedly has given hope to the market, but it is not the end of the story. There is still roller coaster ride ahead. Our recommendation to investors continue to remain neutral weight or equal weight to equities with marginal overweight to large cap and marginal underweight to small and mid cap. But this is a market where every dip is an opportunity to buy and use correction as an opportunity to increase equity allocation. From an investment point of view, bearing few funds, we continue to add value by generating alpha over benchmark indices. Even in hybrid fund, we continue to add value to investors by outperforming benchmark indices. The SIPs, like point-to-point return, bearing few fund, have continued to add value to investors by outperforming benchmark indices. The The same SIPs in hybrid funds have also delivered very good return with very good outperformance. FlexiCap was our flagship fund at more than 35,000 crore AUM. Its long-term track record was remarkable with positive alpha. It did face a rough period over last 3 years, but over last 1 year, efforts taken by Harsha and team have resulted into FlexiCap outperforming benchmark indices. And it's now almost a year where consistently FlexiCap has outperformed its benchmark indices. For the investors of FlexiCap, I can safely say happy days are here again. One more fund of ours, Kotak Pioneer Fund, has delivered reasonably decent performance at par with comparable peers. It puts about 82% in local equity and 18% in global equity. In this category of funds, which has local and global exposure, about 17,000 crore came by way of net inflow. Despite our performance, we haven't received as big a share of this portfolio, as big a share of this flow as expected. I'll strongly recommend all of you to have a look at Kotak Pioneer Fund performance and position in among clients' portfolio. We had launched Kotak Manufacture in India Fund at the beginning of this year. That fund has not only delivered double-digit return, but also positive return over benchmark index to convince investors that fund manager still has ability to add value. The multi-cap fund, which was launched in September 21, has also delivered positive return with alpha in both SIP and lump sum. While lump sum alpha at about 5% looks good, the SIP alpha at 8% is even better. It shows importance of SIP over longer period. The gateway to Mumbai is Gateway of India. Gateway to mutual fund should be balance advantage fund kind of fund. When market goes up, they run up like hare. And when market falls, they come down like tortoise. The balance advantage fund continues to have about 20% to 100% equity allocation. Average equity allocation is 42% because we have never gone above 80% in equity. When market goes up 100%, balance advantage fund goes up by 56%, despite having only 42% allocation to equity. And when market falls, it only gives 36% participation as markets fall. The upside downside ratio of balance advantage fund or Kotak multi-asset allocator fund of fund is about 2 times, fairly impressive. And equity savings fund is at 4 times. Clearly, these are remarkable numbers in terms of protecting downside and yet allowing you to stay invested in market. The current equity allocation for equity savings is about 31%. Multi-asset allocator fund is about 70%. And balance advantage fund is about 49%. Cryptos have felt a massive jolt. NFTs have also felt similar jolt. One NFT of first ever tweet was expected to be valued at 2.9 million. It is now down to just about $96, more than 99.99% erosion. On the gold side, central bankers around the world are picking up gold. That's a positive thing from India point of view. We are the largest holder of gold in the world. And if gold prices indeed go up thanks to central bank buying, we all benefit from the wealth effect. This time, gold hasn't moved as much because US Fed rate was moving in upwards direction. Whenever Fed rates have gone up, gold prices have corrected.
As you can see, the chart in front of you is telling you what Fed is doing in terms of interest rate, and we've been guiding you all that courtesy inflation, Fed is likely to hike interest rates, and basis market expectation as of now, as if the last policy, the rate was hiked by 75 basis points, and we've reached a 4% mark, and it has been one of the shortest span of time where the Fed has hiked interest rate by such a magnitude. And going forward also, though the recent inflation data is softened a bit, but still the market is expecting a terminal Fed rate to be around 475 at this point in time, which had peaked at around 5.25 in the before the data had come. So this is just the beginning in terms of softening of data. If it continues, then probably the hikes may not reach 5 quarter, but 475 still is the expectation of the market. So the slide in front of you is telling you what is the magnitude of interest rate hike vis-a-vis where the yields were last year and where the yields are right now. So this has been one of the sharpest rise in the interest rates all across the curve basis inflation, and inflation has risen so sharply. Initially, it was denied by the central banks that inflation is transitory, therefore the markets were much more complacent, and given the fact that inflation was unabatedly running very high, close to double digit, and probably real inflation was high double digit as well, the Fed was forced to hike rates, and the rate hike came very, very sharply, which led to this kind of move in the bond yield across the curve. So if you look at the front end of the curve, it is still trending for 30, 35. It is very volatile. And if you look at the 10-year bond point, which went to 4 quarter, but after the yesterday's data, it is trading at around 385, 390. So which implies that market is expecting the rate hike cycle to be shallow, and probably in around 2 years you will see the Fed has to reverse the rate hiking. The rate hikes will peak in the next 12 months time, and post that Fed has to reverse these rate hike bets. Probably the economy may trigger a recession because of such sharp rate hikes. If you look at this slide, we have been guiding you on this fact as well, that inflation in the US markets or across the developed markets has been running very, very high if you compare with India, and which has been a key reason where if you look at the performance of the Indian markets in terms of interest rates movement and orderly movement in bond yields and response by the RBI has been fairly decent. In fact, very quite good so far, and RBI has managed to show reasonably well at this point in time, and currency has also been behaving reasonably well vis-a-vis other currencies. However, vis-a-vis the dollar, as all across the currencies have depreciated, therefore we've seen some amount of movement vis-a-vis the dollar. Otherwise, if you look at all other currencies, it is reflecting this fact that our inflation and interest rate are much better vis-a-vis the developed world. So if you look at in terms of differentials, the differential, as I explained it to you, has been narrowing significantly in the last 6 months, as the Fed has been hiking much sharply because of their own fundamentals, and our fundamentals are being reflected into our interest rates and the inflation. Therefore, our markets have not reacted in tandem However, we need to maintain some amount of spreads, and therefore it is very, very important to keep an eye on what the developed markets are doing, because at some point in time it may start impacting, and we should not get caught on the wrong foot. And therefore, while it is quite good to see some amount of softening in terms of data coming out of the developed markets, but if we uh, if we do not maintain the difference at a level which keeps changing from time to time because of the volatility in the market, but we need to maintain that competency level. Otherwise, once things start reversing, that point in time, it may hurt us adversely. Therefore, while the direction is still upwards in terms of interest rates, while it may drag on the sideways for a little time, and then probably continue. And then we may think about tapering once we are confident about the data has completely changed in terms of inflation has started softening for very well within the targeted range by the central banks, and the real growth is coming back again. So this slide is again telling the same story in terms of corporates, high yielding corporates, the AA corporates in the developed markets and the Indian markets. So the borrowing by the corporates in the Indian markets have been much better vis-a-vis the counterparts in the developed markets, because of the factors as I explained it to you during the previous few slides, that inflation has led to a sharp rise in interest rates. If you look at the blue line, the spike has been quite sharp. And if you look at the red line, it is giving a reasonably tapered response and measured response in terms of what kind of levels the interest rate should be as far as our markets are concerned, because they are reflecting our fundamentals, and we are just not following the developed markets. So just to give an instance, just previous slide, to give an instance, as you can see, the number of AA rated corporate will borrow at 876 in the developed markets in the US, and a similar rated corporate in India is likely to get money at around 850. So which is much cheaper than what a US equally rated corporate is going to borrow on a 5.5 year maturity bucket. So if you look at the home loans in where we were in 2012 and where we are today. So if you look at, as explained it to you, everything is boiling down effectively to inflation. That point in time, our inflation was much higher than what it is today. And in the US, inflation was much lower. And therefore, if you look at the home loan rates at that point in time into the US and today, our home loan rates were much higher than the differential was around 7.25%, while as if now we are at around 8.5% in terms of home loans, and the US it has become 7.25. So if you look at in terms of delta, the interest rate cost for average individual has almost doubled. While in India, if you look at the interest rate cost has come down by around 20%. If you look at in percentage terms, or in basis point, it is around 200 basis points. So the differential, which is clearly visible, which can be attributed towards inflation and the interest rate setting, which is positive for economy as such. So real interest rate, again, the real interest rate story is same. We are much better in terms of where we were during every time when such crisis triggers. We always remember the taper tantrum time. And at point in time, the real interest rate between real interest rate in terms of the real interest rate in our country and real interest rate in the US, we were adverse at that point in time, and the gap was around 3%. They were much better vis-a-vis vis-a-vis us at that point in time. And today, the situation is like as good as a mirror image, where the side has flipped, and we are somewhat like they were there at that point in time. And today, they are like ours in terms of real interest rate setting, and inflation is much higher the interest rate setting is, and therefore the hikes are coming in, and they're just trying to reach an equilibrium level. And then at that point in time, if inflation starts reacting to it, then it will be decided whether to lower the interest rate setting or continue to be in similar range for a reasonably longer period of time. So if you talk in terms of equilibrium level, then probably it should be somewhere between 4 to 4-5%, because this kind of inflation which becomes structural, it takes little time to ease off, and the measures are equally harder. So if you look at in terms of currency as well, the currency has done reasonably well and is reacting to what the fundamentals are in terms of real rates. If you look in terms of liquidity, liquidity has been RBI has been draining down the liquidity very quickly, and in response to what has been happening to inflation, and what liquidity surplus we were 6 months back, today we are significantly down to almost neutral level, and liquidity has been sucked out, which is reflected into the overnight markets. If you look at the forex reserves, which is very visible, because the currency was seeing sharp amount of depreciation, so some amount of reserves were used judicially by the RBI in order to protect the currency, but it was not that meaningful what it could have been given the pressures around the world. So it is still at a decent level where we are in terms of FX. The core fundamental question in terms of CPI, CPI appears to have peaked at around 740. Going forward, we may see a good amount of deceleration in terms of CPI, and we should be very trending closer to where it is the comfort zone of the RBI, but however still continues to be slightly higher. But given the momentum into the prices, we believe that the number should trend closer to the RBI, because liquidity has been kept tight and the rates have been risen reasonably sharply. If you look at India in terms of the peer set, developed or the developing countries, we fare fairly well in terms of hike in interest rates and in terms of real rates relative to the peer set all across the globe. So this again tells the same picture in terms of outperformance in the currency market. RNR has been doing fairly well, which is reflective to the core fundamentals, as I was explaining, if you compare with vis-a-vis the emerging market, or if you compare vis-a-vis the developed markets. So this brings to the one of the most important point, and the question which keeps on getting asked by the investors: where should we look to invest, and which is the reasonable or safety point in such a scenario when interest rates are hardening all across the world. So given the fact that the curve has flattened, as we've been explaining for some time, the curve is reasonably flat, and if you look at 3 to 6 year point, it is flat, and after that it is even flatter. Therefore, if you have to, since we are in a scenario where rates are volatile and somewhat hardening for some more time, therefore 3 to 6 year point appears to be the sweetest spot, and it is doing reasonably well in terms of carry and in terms of capital gains, if any, arises due to the volatility. So we believe this is the sweet spot and should be looked at, because it is pricing in somewhat more than what probably the RBI is likely to deliver. So we always advise investors to look to invest, choose a fund vis-a-vis their investment horizon. So if you look at, we have categorized these funds into the short-term, medium-term, and the long-term buckets. And if you have the investment horizons between 3 months to 1 year, then you can choose a money market savings or low duration. And if you have a investment horizon between 9 months to 3 years, you can look at corporate bond, floating rate, short-term, or banking PSU. And if you have a long-term investment horizon, then you can choose a dynamic bond or bond fund for around 3 years investment horizon. And if you observe carefully, the items of almost all the funds are almost similar. However, given the volatility in the fund, you can choose, and the investment horizon, you can choose the fund for your investments. As we've been highlighting, active versus passive, our dynamic bond fund has been outperforming the its respective index on a consistent basis for a reasonably long period of time. Therefore, one can choose actively managed funds as well vis-a-vis the passive managed funds. So hybrid schemes is for, sir has already explained the hybrid outperformance. So we can skip this.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.